Welcome to our lecture series in financial management. Today, we will talk about portfolio management in detail. Portfolio management is the process of selecting, organizing, monitoring, and adjusting a collection of investments to achieve specific financial objectives while managing risk. Rather than focusing on individual securities in isolation, portfolio management emphasizes how assets interact with one another and how they collectively contribute to overall performance. Effective portfolio management balances return objectives, risk tolerance, income needs, time horizons, and behavioral considerations. The primary objectives of portfolio management vary by investor, but generally include achieving an appropriate rate of return, managing and controlling risk, and generating income where needed. It also focuses on preserving capital and maintaining sufficient liquidity to meet financial demands. For instance, a college student investing for long-term growth prioritizes return over income, while a retiree may prioritize income stability and capital preservation. Portfolios can be managed actively or passively. Passive portfolio management seeks to replicate market performance with minimal trading and low costs, aiming for efficiency. Key characteristics include low turnover, minimal trading, low management fees, and a long-term investment horizon. Passive managers believe markets are largely efficient, making it difficult to consistently outperform benchmarks after costs. Common passive strategies include index mutual funds, exchange-traded funds, and buy-and-hold approaches. For example, an investor may buy an S&P 500 ETF and hold it for 30 years, accepting market returns rather than attempting to time the market. Active portfolio management, conversely, attempts to outperform the market through security selection, market timing, or tactical asset allocation. This approach involves frequent trading, higher transaction costs, and greater reliance on research and analysis. Common active strategies include stock picking, sector rotation, and tactical asset allocation. For example, a portfolio manager may increase exposure to technology stocks based on expectations of strong earnings growth and reduce exposure to utilities. Many investors combine both passive and active approaches, using a passive core with active satellite investments. Risk management is a central component, focusing on identifying, measuring, and controlling potential losses. Types of risk include market risk, interest rate risk, credit risk, liquidity risk, and inflation risk. Tools for risk management include asset allocation, diversification, rebalancing, and the use of defensive assets like bonds. For example, during a recession, a portfolio with exposure to bonds and cash typically experiences smaller losses than a portfolio invested entirely in stocks. Income management focuses on generating steady cash flows from a portfolio while carefully controlling risk. Sources of portfolio income include dividends from stocks, interest from bonds, rental income from real estate, and distributions from income-focused funds. Income-oriented assets include dividend-paying stocks, bond ETFs, preferred stocks, and real estate investment trusts. Diversification involves intentionally spreading investments across various assets to reduce risk. This includes diversifying across asset classes, industries, geographic regions, and investment styles. Effective diversification reduces unsystematic risk without sacrificing expected returns. Portfolio management is an ongoing process requiring continuous monitoring and periodic adjustments. Rebalancing is necessary because asset values change over time, causing portfolio risk to drift away from target levels. Common rebalancing methods include calendar-based and threshold-based rebalancing. For example, a portfolio initially allocated 60% stocks and 40% bonds may shift to 75% stocks after a market rally. Rebalancing restores the original risk profile. Investor behavior can undermine even well-designed portfolios, leading to common mistakes like panic selling, chasing recent performance, and overconfidence. Ultimately, effective portfolio management requires discipline and patience to navigate market complexities and achieve long-term financial goals. Thank you for watching our lecture on financial management focusing on portfolio management. See you at the next lecture.